The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial Consultancy. My name is Ketwe Kunene. I am the coordinator for today's session. And today's topic that we are looking at is how to mitigate your risk while improving your returns. Our two presenters today that will be looking at this is Mr. Errol Meyer and Mr. Henk Viljoen. But before I hand over to them, I just want to do some housekeeping, make sure that everybody is comfortable and we're all on the same page. First off, I would like to ask for a favor. I want to check that sound is good on your side. So there's a small high five on a panel on your right hand side. If you see that small high five, if you just click on that, it will indicate to me that you can hear me and that we can carry on. So if I see a few high fives, I'll then continue. Thank you, Ellen. Thank you, Antonio. Thank you, Bonnie. Thank you, Bridget. Thank you, Colleen. Okay. Thank you, Denny. I see a few high fives going up. That means we are all good on sound. You can all hear me. If you'd like the volume to be increased on your taskbar, which is at the bottom of your screen on your right-hand side, just find the volume button and put that up as high as you can so you can hear us clearly. Second thing is questions. You will see that you are muted on your panel, so which means you can't vocally ask your question. But if you do have a question during the session, on the very same taskbar, there's a heading that says questions. You can type in your question for us, and at the end of the session, we'll then pose the question to the two gentlemen that are presenting for us so that we don't disturb their flow during the presentation. So you're more than welcome at any time to type in the question. We'll address it at the end. Okay, hopefully everybody's comfortable. This is going to be about 45 minutes to an hour, so get comfortable and hope you enjoy this webinar. So let me introduce our two presenters today. The first one is Mr. Errol Meyer. A lot of you will know him who've joined us before for a webinar, but if you don't, Errol Meyer is a certified financial planner, an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estates and Financial Plans, which is now prescribed for many universities. He is a renowned lecturer, examiner, and moderator for various universities in South Africa. He currently holds the position of Head of Advisory Prepositions at Standard Bank, which is why we always love having him in the room because he's very knowledgeable. And today his co-pilot, who's equally impressive, is Mr. Henk Viljoen, and he has 34 years of industry experience. He has an MCom in economics, which he got cum laude, and is the co-head of fixed interest. After gaining early experience in the treasury environment at Telkom and at Senbank, Henk Viljoen joined the Liberty Asset Management in 1990 and was appointed head of fixed income. Henk retained this role throughout the amalgamation with Standard Bank Corporate and Merchant Bank that formed Stanlib, and for many years led a multi-award-winning team which built an undisputed reputation as the most astute and consistently successful bonds and fixed income unit in South Africa. In 2008, Henk handed over responsibility for the day-to-day management of all third-party, life asset and retail bond funds. He retained executive responsibility as head of fixed income and chairman of the interest rate committee, the key macro factor forum that determines the duration positioning and Stanlib's fixed income mandates. He now jointly manages the team with Victor Mphaphuli. So you see why today our pilots are so esteemed and why we love having them in the room. So I'm going to hand over now to Mr. Errol Meyer, who will start us off, and then he'll hand over to Mr. Henk Viljoen. Thank you so much. Welcome, gentlemen. Thank you for taking your time to do this for us.
Thank you, Katiwe. Good afternoon, attendees, and a very hearty welcome to our investment webinar. We are privileged to be joined by Henk Viljoen, who has a wealth of experience and is currently serving as co-head of the Stanlib Fixed Investment Team. Now today, we will discuss how investors can maximize the yield of their interest-bearing investments. So many investors still allow themselves to be disadvantaged by putting their monies into traditional low-interest cash investments. Now, the general investment rule, namely to maximize returns while taking on the lowest risk, is well and alive in an interest-bearing portfolio. For example, the combination of cash and bonds may provide substantial diversification benefits. This may, after all, prove to be a less risky investment strategy than to keep funds in a long-term fixed interest rate investment. But before we delve into the investment fundamentals, we must first ask ourselves the question, where do we start? Perhaps a good starting point is to position the investment from a financial planning perspective. It is trite that any respectable financial plan will hold certain assets in cash as an emergency fund. Also, clients may temporarily have cash in their portfolio when selling their house or another investment asset, or perhaps parking a lump sum payment from a retirement fund until a goals-based financial plan and investment strategy is decided upon, etc. In any goals-based investment, the term of the investment is aligned to the term of a particular financial goal. Such a lifestyle goal may typically dictate that liquidity must be available over the short term of the investment. To illustrate, say for instance, one is faced with a scenario where the investor wishes to have liquidity available within 1 year from now for a child's education, and thereafter every year for a total of 3 years, which is for the anticipated duration of the child's studies. Now, in such a scenario, one may be hesitant to have all such funds in cash, since the amount will certainly erode with inflation. On the other hand, one may not be able to stomach the risk to invest a portion in a more risky investment such as equities, since unpredictable volatility may jeopardize the education of a child for a lack of funds available towards the end of the term. The challenge is thus that the investor's risk tolerance from a financial planning perspective is non-negotiable, and that he cannot afford to miss the educational goal for his child and take the risk that his investment will run out of funds, but yet he would like his investment to keep pace with inflation or even marginally outperform inflation. This is simply because the university fees may yearly be adjusted for inflation increases. Now, furthermore, the investment must be safe against the loss of capital, available on a yearly basis, and as stated before, at least keep pace with inflation, since the cost of education surely increases on a yearly basis. It is for this reason that it becomes important to look for safe solutions to be able to move up the yield curve. And I will now hand over to Henk to take us through the investment fundamentals so as to acquire better insights how this can be done. Henk, over to you.
Good morning, everybody. As I said, I'm Henk Viljoen. Thank you for the introduction. I would like to just discuss our different offerings that we've got, which we think are very suitable solutions to your investments. But before we do that, I think it's only appropriate that I tell you a little bit about Stanlib as a business, maybe just briefly talk about how we think about the world and to add the value, and then maybe just show you 1 or 2 slides on where the world are and what's happening in the world at the moment. Maybe before I start, I just maybe firstly want to just say there's a number of yourselves out there today that are listening to this webinar that I think I want to say on behalf of myself and my team, thank you very much for the support. I know many of you have been big supporters of the different products, and some of the products we're discussing today might be familiar to yourselves. So if we talk about the team that we have in our business basically consists of myself and Victor Mpapuli, who has been with me since 2002. We also have Ansie van Rensburg as probably the most experienced and biggest manager of money market funds in our team. The 3 of us have been together for a number of years, and it's very important to think of Stanlib Asset Management as a business of people that has been around for many, many years. We have won a number of awards. As Kitwe said, we've been very consistent in the way that we thought about the world, and we'll try and demonstrate that. So we stand to you today as an offering that hasn't happened yesterday, and we really believe that we manage money not only for the short term, but we really try and add value to our customers over a longer term cycle. If you then look at the whole team of people, you can see that there's quite a number of individuals, and it goes proverbially back to the situation that if I'm not in the office, who's actually looking after the money? And we are very proud to say that we have some really top individuals with a variety of qualifications. You can see there's people with CAs, CFAs, mathematicians in our team. So we have a diverse set of skills of people looking after the money. And we also have a separate credit team that specialize in analyzing the different opportunities that we put into the portfolios that we'll discuss today. Thinking about our philosophy and process then, our philosophy is simplistically to say that we believe that there's inefficiencies in financial markets and that creates opportunities for managers to add value. Now at Stand-up, we are unashamedly active managers. Now if you think about the world we live in today, the world is in lots of turmoil, and what you often want in a turmoil world is somebody to buy when things are cheap and to sell when things become expensive. And that's some of the skills that we actively apply to the different portfolios we manage. Our active participation to the market is often on a very limited risk scale. So the idea for us would be, as we show on the slide, to give 1 to 2% outperformance over a rolling 3-year period. So not taking huge risk, but continuously taking small bets on the portfolio to make sure that we outperform the benchmarks that we have given to us by our customers. And then I'm showing you that chain. Now the chain talks to the different things that we can do in our portfolios. So we can take duration bets. Duration would be to be more or less exposed to the risk of market movements. So a long duration position will be a riskier position than a short duration position. And as a matter of interest, the positions we are holding are actually very low in duration. Then we also have credit positions in the portfolio, and most of the positions we hold in our portfolios would be some form of credit. And we'll touch on that in a moment, and then also yield curve strategies that we apply to the portfolios. So given where we are in the world today, let's maybe spend a moment to look at the current market developments. So what I'm showing you here is a slide on the different movements that we've seen in the 10-year bond yields. Now today we're not discussing the 10-year bond yield, but we're showing you that markets have been going up and down over the last few years, and that graph actually covers the last 10 years. And you can see that when the financial crisis happened, markets spiked and then rallied, and then we had the taper tantrums when Bernanke, the Fed governor, announced that there's going to be no more free money for emerging markets, caused a lot of sell-off. We had Nenegate in our recent past. All of that volatility, we believe, actually represents opportunities for us as fund managers to capture value for our customers. If we look at the slide from Kevin Links, you can see there that the red line is the historical CPI that we've had for the last few years. And what I'm showing you here is our forecast. So we think in South Africa, inflation has been rising in the recent past, but we think that going forward, inflation will be contained and will be stuck in the range of 6 to 3%. Many of you might actually know that the governor of the Reserve Bank, Lesetja, has indicated that he wants inflation in the long to medium term to be around about 4.5%. He's got an aim to bring inflation expectations down in South Africa. So what does that mean? It means that in South Africa, interest rates are probably going to be moving sideways, while if we look at the slide of the US interest rates, our expectation now is that interest rates in America will actually continue to rise. So there's an expectation of up to 3% or 3 more hikes of 25 basis points that could be happening in America over the next 12 months. That obviously is a concern for us in an emerging market, because South Africa, we can see the line moving down over the last few years as interest rates have been coming down, and you look at the red line right at the end, and that's indicating that we think interest rates are now going to move sideways. So what is the opportunity for you as an investor to think about the way that you are managing your money here? So what we've got is a line representing the floating rate market as well as the repo rate market. Now the repo rate is the rate at which the government lends money to the different banks, sitting at 6.5% at the moment, and the floating rate market is the rate that is in blue that sits slightly above that market. Why that is important is because the instruments that we include in our portfolios are actually priced off the blue line, making the ability for us to give you an enhanced yield even more so because you can see consistently over time, the blue line sits well above the rate that is offered by the Reserve Bank to the banks. So let's touch on the first block. So what I'm going to talk to you about today is thinking about being invested in a money market fund and taking some of that money potentially and moving it to an asset investment, which is not totally dissimilar to the money market, but which gives you a better yield outcome without taking necessarily an onerous amount of additional risk. At the same time, the type of investment that you have in a money market fund are very readily available. So the investments that we're going to talk about today is typically slightly longer term of nature. So let me explain that. If you have an amount of money in the money market fund, and that, let's say the amount is 50,000 Rand, and you think that you might want to have a little nest egg in case the car breaks or the fridge needs repaired, that amount of, say, 20,000 Rand you want to have available at all times in case there's an emergency need. However, having the 50,000 Rand in a money market fund over a long period of time leaves you in a position that had you taken the other 30,000 Rand or whatever that amount is and moved it to a fund that gives you a higher yield, but not necessarily taking a lot more extra risk, leaves you in a situation that you could have earned more interest without actually taking an onerous amount of risk, but leaving yourself in a financial position that your interest account is actually much bigger than it would have been had you just stayed in the most conservative fund, which is the money market fund. So having said that, let's look at the money market fund. Our money market fund is the most conservative fund that you can have in your portfolio, giving you on an overall basis around about, call it 7.8%, 7.75%. Now, I must be very clear here. The yields I'm showing you here are the gross returns that these funds produce, and they don't include any fees. The reason why I'm not showing you fees on the numbers is because different entities might be paying slightly different fees. What we want to suggest this morning is that you move some of the money that is not linked to your emergency portion of your portfolio to the Standard Extra Income Fund, and we will touch on that fund in a moment. And you can clearly see that you're moving from a gross yield of 7.8 to 9% doing that in your portfolio. So if we just touch on the money market. Now, money market funds typically invest in instruments where they add the interest every day to the value of your portfolio. It's called accrue accounting. So the value of the money market fund always stays at 100 Rand, and you add the interest every day, and then monthly that interest is paid back to the customer. What also differentiates a money market from an extra income fund is that this fund typically invests only up to 13 months. So it's not allowed to buy longer than 13-month instruments. So it's just short-dated instruments. And the ability to maybe invest a little bit longer is where the opportunity lies in the market. So if you then go to the performance, you can see, and what we've done on all the performance tables, we've put the fund at the top, then we've put the STEFI. Now, what is the STEFI? The STEFI is the benchmark consisting of some 3 months, some 6 months, some 9 months, and some 1-year instruments, making up the benchmark. The benchmark being what we as fund managers aim to outperform over time. And we also show you the CPI on that graph. And you can clearly see that this fund has outperformed the STEFI over the last year, but it's very important. As you can see, there's quite a big gap between the CPI and the performance of the fund. So assume that you invested in the money market fund. What is the alternative that you can consider? So let's talk about the extra income fund. Now, the extra income fund is a fund that, as I've just shown you, sits slightly further up the yield curve. Now, what does that mean? It means that this fund, like a money market fund, will invest in different counterparties. It has the same rigorous credit process. So when we buy instruments for the money market fund, you'll have the same process that covers the extra income fund. And what is important for you as an investor is that it's got the same regulations, and the fund is actually rated AA-. So it has a formal market rating where an independent rating agency looks at the instruments and determine whether it's a good place to be invested as a manager for us. Then what is the difference here? And I think this slide I'm showing you now is very important. You look at the money market portfolio, it typically invests up to 1 year, 12 months, and it would earn JIBAR plus 50, maybe a little bit more, investing with virtually the same counterparties as you'll find in the extra income fund. Who are those counterparties? It would be banks, and it'd be large corporates, Bidvest, Imperial, MTN, all the large corporates in South Africa. The opportunity lies that when you go to a bank or to a corporate, and instead of giving them 1 year money, you give them 3 to 5 year money, they will pay you a higher spread. Now, if you look at the table there, you can see that giving that same counterparty that you have in the money market fund up to 1 year, money for a slightly longer period gives you roughly 100 basis points additional return. And that's where the benefit comes in for the extra income fund. So the kind of instruments which are JIBAR linked in the money market portfolio is exactly the same kind of instruments that you find in the extra income fund. So there's no bonds in that fund that exposes the fund to market movement of bond yields going up or down, because all the instruments in this portfolio are linked to the 3-month JIBAR rate. What it means is that the rate resets every 3 months. On the next slide, we've got the assets in the portfolio, and you can clearly see we have some banks, some corporates, and a number of other exposures, which are all highly rated instruments in the market. From a performance point of view, this fund has done very well. You can see the extra income fund in the last year has given you 9.5%. Now that's slightly different to the number I showed you, because the number I showed you was the number as it stands today. However, the number I'm reporting in this table is a historical number. But you can clearly see that there's a very large gap between inflation and what you are earning on your extra income fund. Now, if we look at the most recent inflation number that came out at 4.5%, look at 4.5% relative to the 9% that you are earning on the extra income fund. So for clarity purposes, I've also included the income fund. Why have I done that? Because I know a number of people in the SBFC network have invested with the income fund, and I think it's only important to maybe touch on that fund to explain where does the differences lie between the extra income fund and the income fund. So the income fund is slightly further on the curve, and you can actually see there's a slight yield enhancement by being invested in the income fund. But in essence, the difference between the income fund and the extra income fund is that the extra income fund, like a money market fund, just buys floating rate instruments. In the case of the income fund, they are allowed to take some bonds into the fund, although limited to a duration, a capital risk of 2 years. Given where we are on the cycle now, and we know that interest rates are likely to be flat, we have virtually no bonds in the income fund. And to be honest with you, basically for the last few years, we've had no bonds in the income fund. So it's been very conservatively positioned. There's one other difference, which is a little bit technical, but the extra income fund is a Regulation 28 fund. So for those of you who want to make a pension fund investment in cash, it qualifies as a pension fund investment, while the income fund is a SISCA, so it's a pure unit trust regulated fund, and that also leads to a slight difference in the instruments that can be held in the different portfolios. So the income fund does have more risk. So if we think about the investment horizon, then the income fund typically would be for an investment of 1 year and longer, giving you a very good safe yield. But I would urge people to think about the return of that fund over a 1 year period. If you move money from the cash space to the extra income fund, I would urge you to think of the extra income fund as something that you want to be invested in with a 6-month and longer time horizon, because ideally we would not want people to use the extra income fund as a transactional account. Because in the case of the money market, you can actually ask for your money and actually have your money in the account on a 24-hour or even on the same day basis, depending when you process your transaction. In the case of the extra income fund, it will always be the next day, because of it's a T+1 fund, while the money market fund could be the same day transaction account. I've got some slides on the income fund. I'm not going to dwell too much on them, but what is important here is that if you look at the income fund, the assets in the income fund is very similar to the assets that are in the extra income fund. So as far as the credit quality is concerned, you can also see that this portfolio, the income fund, has some lower rated quality assets. There's some triple-B assets in this portfolio, and those represent things like the Woolworths offshore transaction. It represents some dark fiber, which is a company owned by Remgro. While if you look at the extra income fund compared to the income fund, you'll find that they only have A-rated instruments. So the extra income fund is even more conservative in the quality of credit that they take compared to the income fund. Therefore, the extra income fund is the 6 months and longer solution, while the income fund is the 1 year and longer solution in your portfolio. So I've also got the long-term line of how this fund has performed, and you can clearly see that over time, this fund has outperformed the benchmark and as well as the CPI in a handsome. So if you gave us 100 Rand 5 years ago, it's worth 150 Rand today in the income fund, while inflation has grown from 100 to 130 Rand. And that certainly is a very handsome return for investors to consider. So we have quite a unique situation at the moment in South Africa, is that at the moment, because interest rates have been left at higher levels by the Reserve Bank and inflation has come down to lower levels, the gap between interest rates in South Africa and inflation is actually quite wide. What we do is we add even higher yields over the current market rate by buying these floating rate term instruments to your portfolio, giving you somewhere between 100 and 150 basis points additional yield, leaving you with a gap that is quite handsome between inflation and where the market rate is from the fund. And I'm going to show you that in a moment. Before we get to that, so you could ask the question about consistency. So what you can see on this slide is that on average, over the last 10 years, in every single year, the income fund has actually outperformed inflation. And I think that's important because when you invest with an investment manager like ourselves, you want to buy an investment that gives you consistency. And I think that's what we stand for our investors. So maybe of value for yourselves then is to look at the future, because what I'm showing you often is based on historical numbers. What I've got here on this slide is to show you the income fund relative to the inflation rate. And you can clearly see that based on our inflation projections, and the green portion are the projections, we are thinking that you could earn quite a nice margin between inflation and what the income fund is going to give you over the next few years. Now, you could replace the income fund with the extra income fund, deducting a small portion of roughly 30 basis points from the green line I'm showing you for the income fund. If you have an investment in the money market fund, your line obviously will be quite a bit lower, but we believe that moving from the money market to the extra income fund does not carry that much risk, but gives you quite a nice enhancement in the return that you're receiving on your portfolio. I've got a slide there on all the fund performances. I'm not going to deal with that in detail, but it does give quite a detailed snapshot of the different performances over the 1, 3, and 5 years. And you can see the further you go up the curve, the better the return of the different funds. And then in conclusion, just to say, I think there's a big opportunity to beat inflation by moving your money up the curve, but still leaving it basically in a cash fund. I think we stand in front of you as a conservative manager, so you're not taking a huge amount of risk. Similar instruments to a money market fund, but just a little bit longer. I think Stand-Up Asset Management has done quite well performance-wise, and I think we've got a nice experienced team that you don't have to lose sleep about who's actually looking after your money every day. That's all from my side. I'm going to hand over to Errol to maybe ask some questions or look for some of the questions coming from your side.
Okay, thank you, Henk. Let's see what questions came through here.
Well, first of all, Errol, before you go into the questions, just some compliments from Manoj. He says, impressive speakers. Thank you very much. So that's for you too.
Okay, well, here's one that I can deal with. I think some of the topics has been covered already, but let's fire away. Henk, the question is, How can I earn more from the extra income fund without taking more risk?
Yeah, so I think that is a very important question. Thank you, Errol. What is basically happening is that the money market fund, because it's investing up to a 1 year period with all the different institutions that it invests, and most of that's banks, we have the benefit in this fund to buy slightly longer term assets from basically the same banks. And if you look at the profile of the portfolios, they look very similar in terms of bank exposure, corporate exposure. But when you give Standard Bank or Absa or Nedbank, whichever bank you choose, money for 1 year, they'll pay you a certain rate. But because you're giving the money for a 3 year period, they are willing to pay you an additional return. And that's where this fund is capturing the extra spread. So the name risk that you have in the portfolio, the credit risk, are similar, but you're actually getting an enhancement because you're just taking more term risk with the same counterparty.
Okay, well, that makes sense. Let's have a look here. Yeah, here's another one. Please simplify the difference between income and extra income fund again, in a very simplistic manner, if you can give it to us.
So the difference is that the extra income fund is actually a long money market fund. It's very similar to a money market fund, invested in floating rate instruments, not taking any capital risk. In the case of the income fund, which we typically want the investor to think of as a 1 year long investment vehicle, we can buy bonds. Now, it has happened over the last few years and cycles. Now, what I can say to you is that I've been invested or involved in this fund for over 20 years. And through the few years cycles, we've sometimes bought some bonds. Now, at the moment, we hold none of them. But when we think interest rates have kicked up because of some event risk or something where the cycle has pushed interest rates up, we could choose to have some bonds in the income fund, although limited amount, but the extra will never have that. So the extra is like a long money market fund, while the income fund will give you potentially a higher return, but does carry a small element of potential capital risk. But at the moment, there's no bonds in that fund, so it virtually looks like the extra income fund.
Okay, well, thank you. We've got a whole lot of questions here. There's one specifically that I'd like to look at. Yeah, this one. Could you explain the advantages of the extra income fund being Regulation 28? Maybe just position Regulation 28 and where does it fit in with the fund?
So if somebody makes an investment in an annuity or a linked annuity, it is required that the funds that you use as building blocks in an annuity or a linked annuity are Regulation 28 compliant. Now, if we think about, and I can maybe just take a step back, if we think about all the turmoil in the world at the moment, where we have crisis in Italy, there's a crisis brewing in Spain, we've seen the dollar appreciate a lot, equity markets are all over the place, and you look at the construct of somebody's annuity portfolio, you might choose to say, I'm worried about where the world is going. I want to move some of my riskier assets, be that property, equities, offshore investments, whatever that might be. You want to move some of that to a less risky investment. But that less risky investment has to be Regulation 28 compliant to be able to fit into a environment as a pension fund building block. Now, the extra income fund is specifically designed to fulfill that space. So for the investor out there who's saying, I want to earn an extra good return in my conservative portion of my pension fund, this fund does qualify as a building block in that pension fund.
Okay, that makes perfect sense. There's a whole lot of questions, maybe 2 or 3 that we can take. Here's one. Maybe we should ask the question and discuss this one. What are the tax implications of this fund? So I think what we are really asking here is it can either be income tax or capital gains tax. So when you look at interest-bearing investments, it is income tax. But income tax is a personal aspect. It doesn't relate to the fund as such. It's about that particular individual or the entity that will invest. But I think for the sake of clarity, and then you can add anything you want to, is that perhaps your exemption will come into play 23,800, and only after that you will be taxed at your marginal rate. You made a community property, you can actually double up on that. And then I also saw another question said, what about a tax-free investment? Well, maybe pick up from that. Can we put it in a tax-free investment? Because that could be a possible solution.
So in a vehicle where you're using a policy or a structure where you are getting the 5-year benefit of a tax-free situation. I think the income fund or the extra income fund could be a building block of that portfolio. So there, the full, let's say 9% that you earn will be tax-free. But let's be honest, we live in a world where when you earn interest, you are going to be paying tax in your personal capacity. What you ideally want, you want to earn the highest possible return so that the net amount after having paid tax, so whether you're in a money market fund or in an income fund, you're going to pay tax in both circumstances. However, in the one case, you might earn 150 basis points more, which leave your net in a better position anyway. But the fact of the matter is, the reality is you do pay tax on the income that you earn on the extra and on the income.
Yeah, and surely this is actually a financial planning aspect. So that depends on the particular risk profile of the client. And then also with financial planning, I mean, there's our retirement annuities. We actually get a tax break. So there's not the one answer that will suit and be the only answer. Let's see if there's anything else. Katiwa, can you see? Yes, one. Okay, this is a good one. Please explain the term of investment in the extra fund. Can I draw money after 1 year?
Yes, so most certainly. So can I just maybe explain? So what we would like to do as a manager is not have people invest in the extra income fund with the view of using it as a transactional account. In the case of the money market fund, you are able to move money around, you can deposit money, you can take money out. We ideally want investors to see the extra income fund as a vehicle where they park their cash, which they are not normally accessing, but want to be invested in cash over a protracted period of time. The reason for us not wanting people to see it as a transactional account is because the instruments that we buy for that fund are of a slightly longer term nature. So if we just practically, when a bank comes to market and issue 3 instruments, they won't do that every day. They will only issue them periodically, and then we buy them and put them in the fund. If you as an investor are selling your units every day, it means that we have to dispose of some of these instruments and are not always able to buy them back the next day to actually make sure that the fund gets this optimal yield. So therefore, we prefer investors to see the extra as a 6 months and longer fund. But most certainly, 1 year is most certainly a period in which you can take your money out. If you are going to be invested in a money market space, in other words, you look at your portfolio, let's go back to the 50,000 Rand that we said, 20,000 Rand you're keeping for the fridge and this unexpected breakdowns. That 30,000 Rand you could typically either choose to have invested in the extra as a money market vehicle, but if that money is going to be invested in cash for a very long period of time, you're always going to have some big cash holding in your portfolio. You might want to consider moving that into the income fund or even have a portion of that invested in the income fund, because that might give you a slightly higher yield, but it is typically a 1 year and longer fund to be invested in.
Okay, Katiwa, we have time for 2 more questions.
Yes.
Perhaps I see there are so many questions. Maybe Henk, you can help me have a look here and find one that is perhaps...
So I see a question here on the enhanced yield compared to the extra income fund. We do know that a lot of people, financial advisors in the bank have used the enhanced yield. So what we unfortunately could not do today is have a whole series of different funds. But the enhanced yield fund basically sit between the extra and the income fund. But we feel that the extra income fund has probably become a more suitable solution to the investor, but it doesn't mean that people invested in the enhanced yield should necessarily sell out of that fund. But I think for new investments, we would prefer investors to think of the extra income fund because it does give roughly 50 basis points enhancement over what you would earn from the enhanced yield. But the enhanced yield obviously invests only up to 3 years with a weighted average duration of 180 days. So it's like a money market fund, just slightly longer. The extra income fund can buy 3 and 5 year instruments, so slightly longer instruments, but the same names as what you'll find in all 3 of those funds will have the same names. It's just about the term of the investments that you buy for the different vehicles.
Okay, well, let's take a last question here. Here I see Grant Berger. Does the 3-month income distribution period of the income fund make it less attractive than the extra income fund? What would your comments be on that?
Yeah, so that's a good question. Thank you. So one of the things that we did at the time when we created the extra income fund is to change the payment of that fund back to a monthly payment. And that's also why we see the extra income fund as a money market proxy. So the income fund pays quarterly, so it sits with a guy with a longer time horizon, looking to obviously earn the highest possible conservative yield that he can earn, but not necessarily relying on the interest on a monthly basis. Now, obviously, you can manage your cash flows around a quarterly payment. The extra income fund was changed to be monthly so that people relying on a monthly income from their interest rate bearing assets have that benefit that, similar to a money market fund that pays monthly, the extra pays monthly. The income fund, however, pays quarterly. But we believe that that is more appropriate because it's for a longer term kind of investment that you're making into a conservative asset class.
Makes sense. Thank you so much, Hank. Thank you so much, Errol. A few of the questions were asking if this is recorded and where you can get the recording. The answer is yes, the session is recorded. You will get a thank you note in a day or two. On that thank you note, you will get details where you can get the recording. It's on our Standard Bank YouTube channel, as well as details of if you want to get in touch with a financial planner. A lot of these webinars are to start that conversation, to give you some knowledge, to start a conversation so you can interact with your financial planner as well. If you do not have a financial planner, please visit one of your nearest branches, or like I say, on the thank you note, there will be details where you'll be able to get in touch with the financial planner and have these conversations and ask more questions about these things. For our internal staff, it is on the Planner portal where you can get the recording of the session today. Thank you very much, ladies and gentlemen. Thank you very much, Hank. Thank you very much, Errol. This was very insightful. I hope you guys got a lot of information from this one. We will see you on the next webinar, which will be in June. So thank you very much, guys. If there's any more questions that you think up of, please don't hesitate to email those questions. There's an email address on the thank you note as well. And then we'll forward it to Hank and Errol, and they'll give you answers to that. Ladies and gentlemen, have a good afternoon. Goodbye.
Thank you, bye.